Hi, everybody. Mynor Ramos here, and I am joined by Mike Domico, where we are going through a series of video recordings talking about the 8 banking principles that you should know so you could elevate your thinking and go from a level 1 finance type of person into a level 2 where your money begins to grow. And then hopefully we can see you on the other side of level 3 where you're really understanding the movement of money, the velocity of money, how to make sure that it accelerates to your benefit. But today, we're going to talk a little bit more about the mortgage amortization. So, in the previous videos, we talked about closed-end loans, then we talked about interest accumulation, and today we're going to talk about the specific document. So, if you bought a home after 2015, that's when the Dodd-Frank Act went into effect, where they were supposed to disclose to you, number one, the interest rate that you pay, two, the APR, which are not the same thing, and the APR calculates the amount of money that it costs you to originate that loan. So this is why somebody might look at a closing disclosure and they might have a 6% interest rate, but the APR is more like 6.75, and they're freaking out. Well, again, they don't explain that to them, right? But in your loan package, there are probably hundreds of pages, and no one ever goes over this with you. I would be shocked, and correct me if I'm wrong. And if you're a listener, or if you're an agent, if you're a mortgage broker, or you're a real estate agent, and you have seen someone do this at a closing table at a title company, and they've discussed this with the client, I will applaud, and I want to know about these people, because here's what they don't know. And people go to a bank because they don't have the money to buy the home, but it's the information that's withheld that causes a lot of the interruption of wealth creation, right? So when we're talking about in the example that we're giving, is let's just take a $200,000 mortgage. I know that's ridiculous because I think everything right now is like 400,000. Simple information. $200,000, 6% interest rate at 360 months. Now you notice that you don't have a graph on the computer. We want you to think with our words and with our explanation and the way that we tackle these topics. We want you to start to think, because you're so used to being entertained and having these little graphs and things like this. You're not going to learn that. So when I describe these numbers to you, it's going to force you to start to think a little bit more. First month of that payment is $11.99 and 10 cents. Out of that, on the interest side, $1,000 goes to the interest, and $199.10 goes to the principal. You see the relationship there? So if you do the math, if you divide 1,000 by 11.99.10, you come up with 83% interest. So let me ask you a question. Where is that 6% that's on your closing disclosure? Well, you know something, in one of those pages, there is a document that actually tells you what it is. It's called the total interest payments that you're going to be paying. It's called the TIP, right? Now, the reason why we're talking about mortgage amortization is because, as you know, the relationship that you have with the bankers is the moment that you sign, you're creating wealth for the banks. So much to the tune of, after 5 years, you would have paid a total of 71,943, and in this case, your equity position is only 13,891. So you take 71,943 minus 13,891. That means the bank has gotten $58,000 of interest. And by the way, if your loan was 200,000 and it's a 30-year mortgage, you would think by year 15 you would be at that halfway mark. Well, the halfway mark doesn't take effect until year 21, where by then you would have already paid $302,173. Your equity position is $100,000, but the bank has $99,877 of interest that you paid to them. That's it. That's an interest percentage of 115%. Now, why do we share this? Look, I'm not trying to bring more pain to your financial demise. Not trying to do that. A lot of you have asked us, you understand mortgages, you understand insurance products, and there's a huge correlation between the two, entities, right? But you want to know the ins and outs of all of this, and this is why we're here. So, on the mortgage amortization, I'm interested in knowing your thoughts a little bit more. And if anything, you want to share anything, regarding the disparity of the relationship between, the mortgagee and the bank.
Yeah, I hate it. I'm on my fifth or sixth house at this point, and every time I go through that process, I want to grab that guy or gal by the throat and strangle them. However, especially for the professionals out there and the wannabe professionals, I'll give you a little clue on how you can really help your client and create some wealth for yourself as an agent. You sit down with that new homeowner and you say, let's get your itemization table out. And they'll bring it out if they can find it. If not, they're all over the computer. You can duplicate it. And you say, I'm going to show you a trick. Most people will buy term insurance to cover their mortgage. Well, that way, if the guy gets, wrapped around a tree one night, the wife and the kiddies have a home. And of course, that's important, and it's a really good basic sale. But why don't we go a step further? Let's use the whole idea of compound interest in reverse for our benefit. And we take out a life insurance policy, and it doesn't matter how much you can afford. Some people can afford more than others. But you write the appropriate policy for that family, and instead of paying a term premium, you pay a little bit more, and you have a cash value, as we refer to it. You then build your atomization table, which is your illustration. And if you put your illustration next to the atomization table, at some point they cross. And you turn to your lovely wife and you say, lovely wife, we can pay off the mortgage that day. And if you're able to do that and you understand how simple a principle it is, you can save yourself hundreds of thousands of dollars of interest because you borrowed out of your life insurance policy, you pay off the mortgage, and now keep making your mortgage payment to you. You've now created no mortgage and wealth and death benefit all at the same time.
There you go. That's a powerful way to look at it. It's interesting to me that when they start looking at this, an amortization table from the banker's perspective is really a 401k upside down, right?
Yes.
Because the average consumer puts all this money into a 401k and like they start out here and then they have to grow, this direction, right? They have to grow it, but that's 20, 30, 40 years. And now they start to get the benefit. Well, what did the banker do? They started at this line. So
right.
Again, everything is crossed, and we're bringing, power and information and knowledge and education to the consumers. Obviously, we're talking to two different types of people here. The insurance agents who, may be captive and looking to go into the independent world. Maybe, they're professional, wherever they're at, it's capped at some point, and they really want to, help their clients further. But the other ones is, the type of clients that want to be educated and want to get to that level 2 and the level 3. So I love this. I think this is great. Thank you for sharing your knowledge, Mike. And for everybody watching, look in the descriptions, the links in the descriptions, and we'll be sending out some more videos regarding these 8 banking principles. Thanks for watching.
Thank you, Mynor.